Hello again. This is going to be the seventh chapter of our course, and today we are going to talk about the equivalence of cash flows and the main topic of the chapter, the cost of the capital. We are going to learn about this term, the cost of the capital, and throughout the whole chapter, we are going to evaluate such costs. So the outline is as follows. We are just going to focus on the equivalence, definition of equivalence once again. Actually, we have already defined the term equivalence in the first few chapters, but today we are just going to put a formal definition onto that. Then we are going to learn about the concept, the cost of the capital, and we are going to study how to calculate the cost of the capital. Actually, there are four main ways of raising capital by companies. So if, as a company, if you want to invest in a project, you need to obtain capital in order to invest, and that capital can be obtained by either taking a loan from a bank or credit company, or you can sell the stocks of your company, or you can issue bonds of your company in the stock market, or you can use your own profits to invest in such projects. Okay, there are four main ways of raising capital by the companies, and depending on the method that they use, there will be a cost of raising that capital, and we are going to define that cost. Finally, in the last phase of our course, we are just going to have a passage through the next chapters. We are going to define the term minimum attractive rate of return, and this term is just going to be used in the following weeks again and again. Therefore, it is very important to understand the definition of this term. And we are going to learn how we can compute the minimum attractive rate of return. And a term that is called the fair market value will also be introduced in this chapter. So this chapter is just going to be a very long chapter. However, the methods that we are going to utilize are just due to the learnings that we have covered in earlier chapters. All right, so let's just put a definition to equivalence one again. So what does equivalence mean? It means the state of being equal in value. Now, you can create this equivalence between any variable. Okay, so equivalence is not just defined for engineering economic concepts. You can create equivalence between different concepts. However, in our course, in engineering economics, the equivalence is a concept that is related with the time value of the money. So depending on at which time the transactions occur, and the specific amounts of money involved in these transactions, and the assumed interest rate, there may be equivalence between different cash flows. Okay, for example, you can purchase a house with a down payment, total down payment as a lump sum, or you can just take a loan from the bank and pay in monthly payments to obtain your house, to purchase your house. Okay, there are several ways of making payments, right? So we are creating equivalences between different cash flows by assuming an interest rate, and depending on at which time the monetary transactions or cash flows occur, or the amounts of money involved in these transactions, there may be equivalence between different cash flow structures. So if the payments are made at different time points, different amounts of cash flows can be equivalent or same. So we are just going to explain this with an example. Let's just say we have borrowed $1,000 of loan, and it is just going to be repaid in $1,060 in 1 year. So we use the single payment compound amount factor, F over P, under 6% interest rate for 1 year, right? Because as you can see, this $1,000 becomes $1,060. So there is a 6% interest that is applied on the loan. Therefore, the compound amount factor F over P under 6% interest rate for 1 year or the reciprocal of it, which is the discounting factor. So compounding factor converts the principal to the future value, and the discounting factor converts the future value to the principal, which is P over F, which is the reciprocal of the compounding factor. These are called the equivalencing factors of this investment. So it says $1,060 1 year from now is equivalent to $1,000 by a compounding factor under 6% interest rate for 1 year, or $1,000 today is equivalent to $1,060 1 year from now by a discounting factor of P over F under 6% for 1 year. Okay. So these two values, although they are not equal, they are equivalent due to the time points that these transactions occur. Okay. Now, this equivalence is only defined by a 6% interest rate. For another assumed interest rate, if you assume another annual interest rate, in that case, we cannot say that these two values are equivalent. So $1,060 1 year from now and $1,000 today are not equivalent under, for example, 7% interest rate or 10% interest rate. So, for example, under 10% interest rate, $1,100 1 year from now is equivalent to $1,000 today. So we are going to study this equivalence term in this example a little further. So let's read the example. It says a company which produces and markets microcomputers has just introduced a new line which is expected to sell for $10,000 per system. So there's a new product which is introduced by this company and it is going to be sold in the market. However, there are some market conditions. Unfortunately, the potential customers cannot pay such a large amount of money immediately. Therefore, the company thinks about offering financial investments. Financial incentives to potential customers. So what does incentive mean? So another way of payment which can ease the payment process for the customer. Okay. So the company has decided to charge an interest rate of 10% compounded yearly and to give customers three options. So the 10% interest, so if, for example, if a customer purchases this product and does not pay, then basically the customer will be assumed to take a loan of borrow a loan of $10,000 from this company, okay, because they have purchased the product but they haven't paid the price. And under this 10% interest rate, the debt will compound. Okay, so there are three options of payment, of course. So in the option one, the customer may pay in 4 equal yearly installments of $3,154.71, which means instead of paying $10,000 immediately, in the end of each year for 4 years, the company may pay $3,154.71. In option 2, the company may pay $1,000 at the end of each year for 3 years, and in the end of the 4th year, a total of $11,000 may be paid. In option 3, the customer can postpone the payment for 4 years, and in the end of 4 years, a total of $14,641 may be paid. Okay, so let's just tabulate these payment options. So all of these three options are 4-year options. So the customers may pay their debt in 4 years of payment plan. In the first payment plan, they may either make a payment of equal payments of in the end of each year as $3,154.71. In second option, the customer may pay $1,000 in the end of the first 3 years, and in the end of the 4th year, a total of $11,000. And in option 3, $14,641 may be paid. So basically, the present value of $10,000, which is the current price of this product, is converted into the annual installments by a factor, by a capital recovery factor. And these installments will become $3,154 in the first option. In the second option, in the first 3 years, the customer is only paying the accumulated interest, not the capital. The capital is $10,000, and each year it compounds with an interest of $1,000. For the following 3 years, the customer is going to pay the interest only, therefore the capital is going to stay the same. But in the end of the fourth year, the capital plus the annual interest will be paid. And in option 3, there is a direct calculation of the future value in the end of the 4 years. So there will be 4 times of compounding of this 10% interest rate, which will make the total debt to $14,641. So in all of these 3 payment plans, if you calculate the present value or the present worth under 10% interest rate, they will be all equal to $10,000. Or if you calculate the future worth in the end of the 4 years by converting the first payment plan with a uniform series compound amount factor, and you can convert the second option again by using the corresponding compound factors. And the third option is already the future value, it doesn't matter. So all of the future worths of these 3 options are going to be $14,641. Okay. Now, all these 3 options, my friends, are the same under 10% interest rate that compounds annually. So these 3 options are equivalent, however, only under the appropriate interest rate of 10%, which compounds annually. Under a different interest rate or under a different compounding period, the equivalence is not created. This equivalence can only be created by a 10% interest rate, which compounds annually. So in order to define an equivalence between different cash flow structures, you need to definitely define or assume an interest rate and a compounding period. Now, for example, under 10% interest rate, all these 3 options have the present worth equal to $10,000. However, under an 8% interest rate, the present worth of the first option would be $10,448.80. The present worth of the second option would be $10,662.43. And the third option will have a present value of $10,761.57. So you see the present values are not the same. Therefore, these 3 options are not equivalent under an 8% interest rate. Under a 12% interest rate, option 1, option 3, and option 2 and option 3 will have the present worth equal to $9,581 approximately. Option 2 would have $9,392, and option 3 will have $9,304 approximately. You see, under 8% interest rate, the smallest present value or the present worth of is obtained by option 1. However, under 12% interest rate, the smallest present value is obtained by option 3. Now you see, the company offers these 3 options to customers, but different customers may choose different options. So how come they will choose different options? Because this 10% interest rate is applied by the company, but from customer's perspective, the customer may assume a different interest rate to calculate or evaluate these 3 options. For example, if the assumed interest rate by the customer is also 10%, then all these 3 options are just going to be the same for that customer as well. However, if the assumed interest rate by the customer is 8%, this customer would definitely prefer option 1. And if the assumed interest rate is larger than 10% by the customer, then this customer would prefer option 3. Okay, so there are 3 different customers. The customers may have different interest rates assumed, and dependent on that, different payment options, payment plans can be preferable. For customer B, all three payment plans are equivalent, but for customer C, the best option is the third option. Why? Because in that case, the profit will be $695.38. How come? So let's just say customer C has a savings account in a bank that pays 12% interest rate. So your supplier applies you a 10% interest rate in each payment plan. However, as a customer, you have a savings account which pays a 12% interest compounding annually. So what would you do? You would pay as late as possible, right? Because the interest rate that is applied to you by the supplier is less than the interest rate that you are going to get from the bank. So if you have $10,000 right now, you would definitely invest this $10,000 into the savings account, and you would gain a 12% interest at each year, each following year. And in the end of the fourth year, you will have a lot of money. And in the end of the third year, you would pay $14,641 to purchase the products, okay, which you actually have purchased already in the beginning of the four years. And this means in the present value, you would have a $695.38 today. Or in other words, if you divide this $10,000 into two parts, you would invest $9,304 to the savings account, which pays 12% interest rate. And in 4 years, this $9,304 will become exactly equal to $14,641. And the remaining $695 will be used for another investment. Okay, it is just your money. But for customer A, the situation is different. Let's just say customer A has a savings account in a bank which only pays 8% interest rate. And this interest rate is a lot worse than the interest rate that is paid by, that is required by the supplier. In that case, the customer A should be paying as early as possible, because every time the payment is postponed, the money is going to lose its value. Even though this customer can gain interest by 8%, the debt that he's going to be in is requiring a 10% interest. Okay, therefore option 1 is preferable by customer A. In fact, if there is a chance for customer A to pay all of the price or products price as early as possible, so they can pay, customer A can pay all $10,000 as a lump sum, as a down payment. Okay, so depending on what type of savings account do you have, okay, different options may be preferable by you. Okay, if you have a savings account that pays a lot larger interest than the applied interest rate in these options, okay, assumed interest rate in creating the equivalence between these options, in that case you need to pay as late as possible, otherwise you need to pay as early as possible. So this example showed that the relative evaluation of cash flows depends critically on the corresponding appropriate interest rate, which is called the pertinent interest rate. So if the pertinent interest rate is 8% or 12%, these three options are not equivalent. However, if the pertinent interest rate is 10%, they are equivalent. And depending on the pertinent interest rate, one of these options may be preferable compared to the others. Okay. Now, the pertinent interest rate, which determines the time of the value, time value of the money, is not usually known, or it is easy to determine. Okay. So, for example, as a customer, you are not just going to compare all these three options by looking at the interest rate that is applied to in your savings accounts. Okay. Now, there are other ways of finding this pertinent interest rate or the assumed interest rate in order to make these comparisons. Okay, one thing that you can do is to check the interest rates, of course, that is offered by the banks or credit companies. But for large companies, since bank loans are not the only ways to raise capital, they are going to evaluate their pertinent interest rate to make this comparison with a different method. Okay, so for a large company, if they intend to make an investment into a project, or in order to find this project's cash flow equivalent value, they are going to use an interest rate, which is called the pertinent interest rate for them, okay? Depending on how they raise the initial capital of this project. And there are several ways of raising capital. And this interest rate will be called the cost of the capital, okay? So the cost of the capital, the term cost of the capital, is not a monetary unit. It's an interest rate, okay? It depends on how you raise the capital. So under which interest rate you have raised the capital. For example, as an ordinary person, okay, as an ordinary individual, if you just apply for a loan from the bank, and if the bank offers you a loan under a compounding interest 10% per year, then the cost of that capital, the cost of the money that you have borrowed, is just going to be 10% per year. So this is the interest rate. The cost of the capital here is the interest rate. And every time when we are mentioning about the cost of the capital, we should talk about an interest rate. The interest rate under which the capital is obtained is called the cost of the capital. So there are several ways of raising capital for projects. So we are just going to cover 4 of them. You can either borrow a loan from a bank or credit company at a specified interest rate. In that case, the cost of the capital will be this interest rate, annual interest rate. Or you can sell your company stocks in the stock market, okay? And this is, of course, increasing the number of owners of the company. When you sell your company stocks to the public, in that case, you will raise a capital, but the number of owners of the company will be increased. And of course, this is also going to decrease the equity of each stockholder. So the shares that you own of your own company are going to decrease as a percentage. This is selling company stocks. This is another way of raising capital. You can issue bonds. You can issue bonds to the public, which means borrowing money from the public. Okay, so you are selling companies bonds, which means you are borrowing money from the public. We are going to explain a little further about the term bond. And you can use your own profit. Let's just say in the last year, your company has made $50,000 of profit after paying the salaries of every employee and all of the costs. There is a net profit of $50,000. Now you can use your own profit to invest in future projects as well. It is your own money after all. However, still there is a cost of that capital as well. Okay, because otherwise this profit would be distributed to the shareholders, and as the board of the company, if you decide not to distribute this profit to the shareholders but use it in increasing the size of the company with a project, now of course the shareholders are just going to oppose to that idea. And of course, there will be a cost of that capital as well. Okay. Now, when the companies invest their capital into a project, the capital that they have raised is obtained not just by a single method that is mentioned here, but a combination of these methods is employed. For example, the company, if they intend to raise $100,000 of capital, some part of this capital is borrowed as a loan from a bank. Another part of it is obtained by selling company stocks. Another part of it is obtained by issuing bonds, or another part of it is obtained by reinvesting their own profits. Okay, so a combination of the methods is employed usually. Now, we are going to study how we can calculate the cost of capital. And what is the cost of the capital? As we have mentioned, it is the interest rate that is incurred in raising the initial capital. Okay, so if you obtain your capital just by getting a loan from a bank, then the applied interest rate is called the cost of the capital. Okay, so the cost of the capital is not a monetary value. It is measured as a percentage. It is an interest rate. And of course, it depends on the choices we have made to raise the capital. So what are these choices again? Borrowing a loan, selling company stocks, issuing bonds, or reinvesting profits. So if we want to calculate the cost of the capital, we need to be able to perform the following evaluations. We should be able to evaluate loan, or evaluate stock, or evaluate bond, or the cost of the reinvesting profits. So if our capital is raised by only one of these methods, how can we find the cost of the capital is the question. And in the rest of this chapter, we are mainly going to focus on the cost of capital calculation under each of these methods. So in the next video, actually not in the next video, let's just say let's just cover this part as well. We are going to start stock valuation in the next video. As I have previously said, if the company raises the capital for a project through just by borrowing a loan from a bank or credit company, the cost of the capital will be equal to the annual effective interest rate. So for example, if we borrow $10,000, which is to be repaid as $11,200 in the end of the year, the cost of this capital will be 12%, because there's a 12% interest rate that is applied to this borrowed amount, to this capital, to this loan. Therefore, the cost of this $10,000 will be equal to 12%. We say that the cost of the capital for loan is 11,200 minus 10,000 divided by the initial principal, initial borrowed amount, and multiplied with 100, so we can convert it to a percentage. The cost of the capital of this loan, the cost of this loan is at 12% interest. Now let's solve this question to study further loan valuation. A bank offers us $10,000 to be repaid in 24 months with equal payments of $450. So we are going to borrow $10,000 right now. We are going to repay this $10,000 to the bank in 24 monthly installments. In the end of each month, we are going to pay $450. If we accept this offer, what would be the cost of the capital is asked. What is the cost of this capital? Now, we are going to first determine the monthly interest rate that creates these equivalents. Okay. Now, you see, this is the initial principal. This is the payment in each month. And the ratio between the annual payment, or not annual payment, the ratio between the monthly payment and the principal is 450 divided by $10,000, which is actually obtained by the capital recovery factor under a monthly interest rate of I for 24 months. So we are interested in the monthly effective interest rate that creates this equivalence. So what is the applied monthly effective interest rate? So of course, we need to use the compound factors table to determine the corresponding interest rate here. Now, the ratio between A and P is 0.045. Now, if you check your table, So let me open the table here. So A over P for 24 months, is 0.042 for 0.25% interest rate. So we are looking for 0.045 exactly. So we are just going to move through the pages. So for 0.50% interest rate, A over P, or the capital recovery factor, is 0.04433. And if we just move one page further, for 0.75%, the monthly for a capital recovery factor would be 0.04568, which is larger than 0.045 for 24 months. And this means the monthly effective interest rate that corresponds to this equivalence is just between 0.50 and 0.75%. So we are just going to apply a linear interpolation between these two values to identify the monthly interest rate. And if you are careful, you can easily realize that 0.045 just in the middle of these two values, just in the middle. Okay, so you see there is a 0.00068 units of difference between this value and 0.045, and between 0.045 and this value, again, we have the same distance. Therefore, the corresponding interest rate that creates this equivalence is 0.625 as a percentage. Okay, so this is the percentage interest rate, monthly effective interest rate, that creates an equivalence between $10,000 and $450 of monthly paid installments for 24 months. Now, of course, remember, when we are talking about the cost of the capital, we are only thinking about the annual effective interest rate. Annual effective interest rate. Okay, so the annual, the year, is the time unit for cost of the capital. So we cannot say that this percentage is the cost of the capital. This is just the monthly effective interest rate that is applied by the loan company, okay, the credit company, the bank. We need to determine the annual effective interest rate, which is obtained by calculating the monthly compound factor as 1 plus the interest, monthly effective interest rate, as a decimal, which is 0.00625. And then we are just going to take the power of 12. So we are going to multiply this monthly compounding factor with itself 12 times. And that is just going to give us the compounding factor for a year. And if you subtract 1 from that, you will get the annual effective interest rate as a decimal. And by multiplying it with 100, you would convert it to a percentage interest rate. So 7.76% is the cost of the capital of this loan. So this company borrowed $10,000 from the bank, and the bank offered a payment plan like this. Under this payment plan, the cost of this $10,000 is 7.76% per year. This is how we calculate the cost of the capital for the loans obtained from banks or credit companies. Now, in the next videos, we are going to learn how we can calculate the cost of the capital if we sell stocks in the stock market or bonds in the stock market again. We are going to learn about those in the next few videos.